All right. Well, again, welcome to our Fall Market Outlook webinar. My name is Jeff Burney, Chief Client Officer here at Curi Capital, and I'm joined by my colleague, Chris Graff, who's our Chief Investment Strategist. We wanted to, again, welcome you all here, give you a brief overview of, an update on the business side and who we are, and then we'll jump into, about 25 minutes or so of market commentary on all things that are going on from our vantage point. And then we'll open it up for Q&A. So we've got some questions that have been submitted in advance, so we'll be sure to answer those, as well as anything that gets submitted during the live broadcast here. So there's a Q&A button or feature down at the bottom of the screen. Please feel free to click on that. You can type in any question that you have now or as we go through our presentation. So with that, Chris, if you'd like to advance the slide. Quick overview for those of you that are new to Curi Capital and joining us possibly for the very first time. Ultimately, Curi Capital, we're an investment advisory firm that is looking to preserve and grow the wealth of individuals, families, institutions, and employers. We do that across our 10 different offices in 8 states. And today, our headcount of the firm is about 180 employees. We, service about 3,000 plus clients, and that, spans about $13.5 billion of assets that are entrusted with us. So we do that across 5 different lines of business, which I'll touch on right here. And then the short takeaway here is that, no one is too large or too small to be working with us. So we cover clients based on their needs and the investment offerings and things that are appropriate for them across 3 different wealth segments within the private investment side. We work with employers in our retirement plan solutions teams on their retirement plans, and we bring that all together with our investment management business that is headed up by Chris, but ultimately is actively managing and actually managing individual stocks and bonds on behalf of all of our clients. So before we jump into things and I turn things over to Chris, I just want to give you a quick high-level update, and hopefully all the comments will tie this back through. But from the individual perspective, listening into our market outlook, some of the key takeaways we want to take is we've had really strong performance over the last few years, and we don't want that to become a distraction or allow people to just sort of sit back and say, I can continue to let my allocation ride as is. This is, in our opinion, a really good time to be revisiting your long-term plan, your asset allocation, ensuring that the risk profile that you have today, matches with where your goals are, and that it, is certainly a time to be, contemplating taking some of that, risk or, return off the table and reallocating the portfolio to be more defensive in today's marketplace. That's based on, and we'll go through it, but valuations and concentration within the equity markets, and also, the propensity for the Federal Reserve to continue to be reducing interest rates. So a lot to consider there. We'll also bring in the topic of further diversification and expansion within the alternative asset space, and the use case for that. So wanted to make sure we put that disclaimer up front, and we'll now share more of the supporting data behind that thesis and what we're thinking about for where we've been this year and where we're headed next year. So, Chris.
Thanks, Jeff. And thanks again to everyone for joining us today for our market outlook discussion. As Jeff alluded to, there are many different things we could be talking about today. So many topics that are top of mind for investors and clients, ranging from inflation and interest rates, monetary policy, tariffs, taxes, regulation, deregulation, new legislation. So many things we could be talking about. We really do want to focus the conversation on a couple of key topics, especially as we think about heading into next year and what should be top of mind for all of our clients and investors as they think about their allocations and investment plans. So Jeff alluded to this, but we'll jump into the trends and recent trends and what's been going on in the stock market. Public stocks, of course, make up a large percentage of most client allocations, and have been a really good source of long-term returns, especially over the last couple of years, as Jeff mentioned. That's led us to a place, the outcome of that has been a market that's been relatively concentrated, as we can see on the right-hand side, and relatively richly valued compared to historical averages, as we can see on the left-hand side. So there's a variety of different color coding on the chart here. If we look at just the left-hand side and look at the price to earning ratios of the S&P 500 index as a proxy for the larger cap part of the US markets, we can see that in the black line in the table at the top, and then we can see the breakdown of just the top 10 companies in the index in the green, and then the other 490 companies in the S&P 500 index in blue. So no matter how you cut it, whether we look at the whole index or look at the top 10 or just the remaining companies, overall, the market, the broad market, just as a proxy for the S&P 500, is trading at above average valuation levels today. And we'll come back to that again as a part of the conclusion and just emphasize this point again. But that leaves us in a place where there's some risk in terms of having continued allocations, sort of broadly speaking, be overweight to public stocks. You can see here some comparison going back to the 1990s, which has been a top question for people as they think about this cycle versus what we saw in another technology cycle in the late 1990s. And you can see some comparisons and evaluations for the larger companies in the index compared to where they were before. On the right-hand side, what's been interesting in this cycle is a lot of the value creation or value capture in the recent tech cycle has really been captured by a handful of companies. And that's led it to a place, as you can see in the black line on the right-hand side, that the top 10 companies in the S&P 500 index now make up over 40%, a little over 40% of the entire market capitalization for the broader index. So that's unprecedented. You can see the comparison back in the 1990s, which was a little above 25% in terms of top 10 market concentration. So we're at a much more concentrated level today. So we thought it was interesting to just look at this snapshot as well of who are the companies in that top 10 leadership group. This chart takes a snapshot in 10-year increments starting back in 1985, then 95, 05, and so on. And the color coding shows us when a company first showed up in this leadership group, and then if they carried through into prior years or successive years. And what you notice on the far right-hand side is today a much larger value in terms of all the companies that are in the top 10 group compared to prior years, prior points in history, and a lot of new entrants into this leadership group. And of course, it's dominated by some of the large cap tech companies that we hear about in the headlines, the so-called Magnificent Seven. So that includes companies like Broadcom, Amazon, NVIDIA, and stalwarts like Microsoft and Apple as well. So a lot of technology leadership in the market today. And what's different compared to what we saw in the late 1990s is that the fundamental trends behind this leadership group, behind the broader concentration, behind the averages in the broader market, the profitability levels and the quality of the balance sheets for these companies is actually pretty good compared to what we saw in the last tech cycle coming in the late 1990s. So this chart shows us the trend in trailing profit margins in the yellow line, and then a measure of debt relative to a proxy for cash flows in the black line. And you can see the trends are going in the right directions. So in an aggregate sense, the overall profitability of companies behind the broader index has been improving, and the quality of their balance sheets has been improving as well. So the fundamental trends have been pretty good. What we've been a little bit more concerned about is the level of earnings growth concentration. This chart shows us a nice breakdown of just those top 7 technology companies, the Mag 7 in green, and then the other 493 companies in the S&P 500 index in blue, and looks at annual earnings growth levels year over year for the last couple of years. We've shown this chart before in some prior conversations like this, and what we alluded to in the past was the level of growth that was really concentrated in these large tech companies back in 2023 and 2024, as you can see in the middle of the chart, with 30% plus earnings growth rate. So that really helps support their strong appreciation, which then resulted in relatively strong enthusiasm and higher valuations for those companies, and ultimately this level of market concentration that we're seeing today. What we've said about this chart and this trend in the past has been, if we expected to see continued appreciation in the broader market, there would need to be some broadening out of earnings growth into other industries, other sectors, other parts of the market. And the good news here is that's what's happened this year, as you can see in the column there for 2025, based on estimated earnings, actual reports for this year up until this point, and some assumptions about the end of the year. So earnings growth for the large tech companies has slowed down. It shows 21% on this chart, but earnings growth for the rest of the market is starting to pick up a little bit over 7% for this year. And you can see the trend continuing into next year. So that's really encouraging, even as the growth in the larger companies slows down, even at really high levels today compared to where it's been. But what's really important is that broadening out of earnings growth in other industries and sectors going forward. So there's a variety of different reasons for why that could be taking place. A couple of different factors could be decline in interest rates, could be other things that are coming into play in terms of productivity improvements. One thing that we think is happening is the impact of new technology in more companies outside of just the largest companies have really been able to take advantage of some of the newer technology initiatives, given their scale and resources and budgets. So this chart shows the outcome of an academic study done by Stanford at the end of last year that just took a snapshot of a number of different types of typical tasks, common tasks, whether it's writing at the top of the chart or technology design at the bottom. You can think of that as like software coding, and just compared doing it in the more traditional sense without generative artificial intelligence technology, generative AI, or with some of these new technology applications. And the takeaway here is that on average, the time savings was anywhere from 50 to 75%, depending on the type of task. But just think about that in terms of the impact across a broader organization, the number of repetitive tasks per person throughout an entire organization. And you can think about the potential productivity impact and efficiency gains, the potential profitability improvements, depending on how that time is spent. So again, something that was largely captured in the early years by larger companies is now, we believe, having a little bit more of a trickle-down effect to other companies and other industries as well. The good news is as the infrastructure is being built out behind this technology that we can all take advantage of and are leveraging in different ways, that is also leading to some trickle-down benefits in other more traditional industries. This chart shows, let's call it the supply chain or sort of the investment infrastructure behind what's supporting some of this AI technology. And what I'd highlight here is number 1 and number 3 on the chart. Infrastructure, so energy infrastructure, data infrastructure. So that can mean power generation systems, or data infrastructure, data centers. But a lot of that translates into traditional construction activity, building buildings, building infrastructure, connecting power, water supplies, cooling systems. So a lot of different things that have now also benefited more traditional industries in terms of things that would be more typically considered blue collar, even outside of the benefits of just AI or applications or software technology. So good, let's call it distribution or dispersion of the technology impact across different industries and sectors. And there we think we're just getting started. So this chart shows the trend in labor productivity going back through the 1940s. This is output per hour across all workers, non-farm productivity. And then highlighted across that blue line is the introduction of different innovations or different technologies in prior years. And what I'd focus on here is in the middle of the chart in 1991, the introduction of the World Wide Web. So the internet as we know it today. And you can think about everything that's taken place since then that led to where we're at today in terms of all the different things we use the internet for, whether that's online shopping, e-commerce, payment systems, or connectivity for our mobile devices. So major advances from the introduction of that technology. And then if you look at the far right of the chart, you can see that it's just been in recent years that we've started to see the introduction of this newer AI technology. The public launch of ChatGPT here identified in 2022, and then broader mainstream adoption of these more foundational models just within the last year. So we think we're still in the early innings of this new technology cycle. We think there are plenty of benefits for the broader economy in terms of productivity improvements or efficiency gains still to come as this technology gets better understood and more broadly implemented in different ways. So that said, of course, there's lots of fits and starts along the way, as we all know. If we can think back to the technology cycle in the late 1990s and the boom and bust that happened in the stock market around then, We know that while the fundamental trends look good and we're excited about the longer-term potential benefits from the productivity improvements, we want to be prepared, given where valuations are today, for a wider range of outcomes. So even despite the strong benefits from new technology, we're seeing some interesting trends in different areas of the financial markets. And so we've used this chart before, but it just highlights a couple different ways, different trends across different types of assets in the financial markets that are sending us different signals about what the markets are paying attention to and what some potential risk factors might be. On the far left-hand side, we've got risk assets, the S&P 500, so large cap US stocks, high yield bonds below that. In the middle, we've got safer assets, so short-term treasury bonds on the top, longer-term treasury bond yields on the bottom. And then on the far right, we've got the dollar and gold. So if we go back to just the enthusiasm and the optimism around new technology, you can see that in the trend in the S&P 500 index on that upper left-hand chart. But then if you look across the other assets and the other asset classes, see some interesting dynamics where shorter-term interest rates declined while longer-term interest rates rose for a period of time and are flat to slightly higher compared to where we were in April, when there was first some concern about the launch of tariffs. You can see the weakening in the dollar on the far right and the strong appreciation in gold since then. So a variety of different factors that are telling us that while there is some enthusiasm and optimism around new technology, and that's showing up in the stock market in particular, there are plenty of other factors to continue to pay attention to, whether that's inflation, trends in interest rates, fiscal policy, the federal debt burden. All of those dynamics are showing up across different market indicators. So we want to be prepared for a wider range of outcomes. We've highlighted that in prior conversations, and the best way to do that is to have a diversified allocation. So this chart, there's a lot of information here, but it really just shows the different types of public investment categories across stocks, bonds, US stocks, international stocks, commodities, gold, other things that are easily investable in the public markets. And through a normal process, we can build a pretty good diversified allocation that can weather a variety of different environments. The challenge has been more recently that behind some of these categories, the number of investable companies has started to decline in the recent years, and especially over the past few decades. So this chart helps tell that story. If we look at the upper left-hand side, we see the number of IPOs per year going back through the 1980s, 1970s. And then we can see a strong trend up until about the late 1990s, and then a dramatic decline in the number of companies going public. So this is when a private company enters the public market by selling shares of its stock to the public. So you can see the dramatic change and decline since the late 1990s, with the number of new companies being relatively low entering the public markets. The chart right below that is similar in that it shows us the average age and size of a company when it does move into the public markets. So we can see the trend there has been that the companies that have been private before they go public are staying private longer and reaching a more significant scale, so a larger level of establishment or maturity before they go into the public markets, sometimes often bypassing the smaller mid-cap space and moving right into the larger cap universe. All that summarized on the right-hand side, we can see a breakdown of companies with over $100 million in revenue, split between public and private companies, the public companies on the left-hand side, private on the right. And you can see the gross numbers there. So about 3,000 publicly traded companies today with over 100 million in revenues, compared with 18,000 private companies. So a multiple larger and significant in terms of the investable universe of private companies compared to publicly traded companies today. If you do the math and the breakdowns between the revenue categories that are color-coded there, there's about 200 publicly traded companies with over $1 billion in revenue compared to about 2,000 private companies today. So this shift over the last several decades has really taken a number of investable companies out of the public markets and put them into the private universe, where they are accessible through different means of investing, different vehicles. But it's created this opportunity where the assets, the capital going into these private investment structures has really expanded over the past several decades. So this chart breaks down a number of different investment types and categories with company-related, public company, private company-related categories on the left-hand side, lending to those companies, private debt or credit in the middle, real estate, infrastructure, natural resources, other types of private investment opportunities. And the message from the chart, while there's a lot of information here, is just that the level of returns historically for these types of private investments that you can see in the medians, the black bars on the chart, has been relatively good in most categories, and that the range of dispersion around returns, so those decile ranges in the far green or red bars showing the decile ranges, just tells us that there's a wide range of dispersion there, so a relatively inefficient market compared to what we see in the public space today. So there's a good opportunity to find interesting investment opportunities across these categories and add some good value by identifying the right managers and the right strategies to introduce into an allocation. The other improvement in the availability of this investment universe has been through the launch of so-called evergreen funds, evergreen private funds over the last several years. This chart breaks down the different types of categories within that type of fund, but the message here is just that these funds are more accessible than a traditional limited partnership structure or other types of private fund structures that are more locked up in a liquid and typically only available for qualified purchasers or a higher accreditation standard. There's more funds today, as you can see on the chart, that are now more accessible and more available for a broader range of potential investors. So good potential set of return opportunities, good new ways to add a diversification into a traditional asset allocation, and a number of new ways to access these types of opportunities. This chart shows the punchline of all of this potential benefits from diversification. If you look at the middle, it just shows the traditional mix of, say, 60% stocks, 40% bonds, and what the introduction of private investment alternatives in this chart could do in terms of improving the possible risk and return characteristics of that allocation. Now, this chart is fairly stylized, goes back through the 1990s, and I wouldn't put too much emphasis on the data here, but the point is that there is an opportunity to improve the benefits of diversification by looking at the possibility to include these investments. Sometimes they can have different risk characteristics, but often they also bring with them less correlation to public markets and can add some real value in terms of helping to prepare a portfolio for a wider range of outcomes. Okay, so I'll wrap it up here with a few more slides to just emphasize some of the key points. As we think about where the stock market is today, one of the bigger questions we get from clients and investors is just, are we in a bubble related to all of this new investment and spending related to AI technology? And the answer is we don't know. We can make some comparisons to prior cycles and have some assumptions about the potential benefits going forward. But what we do know is that over really long periods of time, stock prices tend to track earnings trends over longer periods of time. So this chart shows the trend in the S&P 500 price index in the yellow versus forward earnings estimates for the index in black, going back through the 1990s. And you can see that there are periods when prices get ahead of earnings or when earnings get lag prices, get behind prices. And where we're at today is that prices are definitely ahead of earnings, and that's illustrated by the higher price to earnings ratios that we see in the market today compared to longer term averages. So that leads us to one key conclusion, is that even as this technology cycle looks fundamentally a little bit different than what we've seen in the past, we know that paying higher prices for any investment today, a higher valuation, is likely to lead to lower future returns over time. That's not always true over shorter periods of time, which is what the chart on the left-hand side shows. But over longer periods of time, the price you pay matters a lot in terms of the forward expected returns. So if the valuations that which you see on the right-hand side are in the 20 times range today for the broader market, the S&P 500 large cap US stocks, we know with a little bit historical analysis that the expected level returns over a 5-year period looking ahead might be much lower than what we're used to expecting, definitely what we've seen in the last couple of years, and perhaps even below longer term averages. So we just want to emphasize that point as we think about building allocations and being prepared for a wider range of outcomes going forward. With higher valuations in many markets today, we should all be expecting a little bit below average returns across a number of different categories. This chart summarizes our estimates, our own internal estimates that we produce annually for a number of different asset classes and investment categories. But the takeaway is really there are some places where there are better relative values based on valuations and some better relative potential longer-term return opportunities that we want to make sure that we can add those to client allocations where it makes sense based on their longer-term goals and objectives. So fundamentally, the outlook is good, but valuations are challenging where we're at today. And there are a number of other potential considerations in terms of risk factors that we want to make sure to be prepared for as we think about the plan heading into next year. Okay, so I'll stop there. Jeff has come back and we'll open it up for questions.
Thank you, Chris. And just a reminder, at the bottom of the screen there's the Q&A box. So if there's any questions that come about, please feel free to submit those. We've gotten a few and we had some in advance. So we'll jump into things. But again, thank you for that, Chris. I think a couple of the questions were really tied back in, and we can just maybe put a finer point on them since they were asked in advance. But thinking of the outlook for next year, recognizing the valuations are high. A lot of it's been driven by the concentration of those top 10 or the Mag 7 stocks. And we may have more insight after today's earnings release from NVIDIA. It's kind of the big one for everyone. But any expectations or predictions for what that looks like in 2026? Recognizing that's also a short period of time to be predicting.
Yeah, it's really hard, right, in short periods of time to have any level of confidence. But again, for the larger tech companies, the fundamentals are actually pretty good. Their earnings growth has been strong. Their profitability levels, they've been growing at really rapid clips. So they deserve a good chunk of the appreciation they've seen. So now has it gotten a little extended and the valuations maybe gone too far in pricing in future growth? Perhaps. It's always hard to tell and we don't know for sure, but we'd much rather prefer owning companies that are a little less expensive today with, if we could find them, with as good of fundamentals for sure.
And then thinking about it from like a geographic standpoint, I think we've focused a lot on the US here, but international markets, despite the headlines, emerging markets as well as the developed have performed relatively well this year, certainly in comparison. But thoughts there as far as thinking about total allocation?
Yeah, we've been really pleased with the performance of international stocks this year. Some of that has been the benefit of a declining dollar, but a good chunk of it has been just a shift in the trend in both fiscal policy overseas relative to what we're seeing here in the US. So a little bit stronger emphasis from many of the developed countries overseas to provide some infrastructure spending and support to their economies that is helping to stimulate growth for a number of different industries. And then we are seeing improvement in earnings growth trends for many of those larger companies overseas as well. So the fundamentals look good, but usually what we've seen in past cycles is that several things have to line up: cheaper valuations, better earnings growth, and a weakening dollar. And when those do line up all at the same time, we get a good outcome like we saw this year with better performance, better returns for international stocks relative to the US. So the trends look like they could continue into next year, but we'll see.
Excellent. Along those same lines, just thinking, on the equity side of the portfolio, we've talked a lot about AI, and its impact, and it's certainly driven valuations and excitement and enthusiasm in the marketplace. But if you were to, express that, and I think also how we are currently expressing that in portfolios, where would you sort of turn and look, and maybe what you would avoid?
Yeah, it's a great question. We get that question a lot. It's difficult to answer, right? There are a number of companies that are really directly related to the infrastructure spend that's going into supporting the technology, whether it's companies like NVIDIA or whether it's service companies that are also building applications and helping deliver solutions for customers who want to use the technology. But there's also a number of different benefits happening in many companies in every industry. So the use of the technology can have lots of potential benefits across different industries, including things like we referenced in the conversation around construction industries, helping to build the infrastructure supporting all of this development. So there's a number of different ways that companies are benefiting, and many companies in many industries are starting to show some of those benefits in a more consistent way. So it's a challenging question to know if NVIDIA is going to continue to perform the way it has been. Our hunch is that a lot of future growth has been priced into the stock today, and we would prefer to try and lean to other companies and other industries where there's cheaper valuations, better relative value, and less of that potential future growth is priced in.
Yeah. So, possibly too soon to, put all your eggs in one basket as far as the winner takes all strategy.
Absolutely. Yes. Yeah. Thank you. So it's much like we saw in the late 1990s. If you think back to the internet boom, it was really hard to know. There were so many new public companies entering the markets, really hard to know who are going to be the long-term winners. And if we think we're in kind of the same place today, the longer-term winners are probably not the chip makers, are probably not the hardware providers. But this technology is a little bit different, so it's hard to say exactly who will be the longer-term sort of biggest winners in terms of value capture from the new technology and new innovation.
Switching gears just a little bit, thinking about, diversifying in portfolios. So we had talked about the, inclusion of, alternative investments, and those can be, a far-ranging definition of what those include. One, how are we doing that for clients, just in generally how we're accessing it? And then, the follow-on to that is thinking about cryptocurrency as another potential diversifier and how that may play a role in portfolios.
Yeah, great question. So on the private investment side, historically for our clients, we've used structures to help them invest in private investments through different types of private vehicles, but those often have been relatively limited to more higher accreditation standards, and it created more complexity. The good news that we try to emphasize in the slides is that there are some newer structures that are a little bit more readily available across the public markets. They're still relatively illiquid, so they're not necessarily appropriate for everybody, but it gives us more ways to access those opportunities and more ways to potentially build investments for clients in different areas. Just to emphasize something I tried to say in the presentation too, a lot of these investments have different risk characteristics. So it's not necessarily the case that they're lower risk with higher return, but they have different risk factors. But those risk factors, and when they're less correlated with other things in the market, can still benefit an overall allocation. So again, a great conversation for if you're interested as a client, potentially thinking about how that could be part of your allocation. Great opportunity to talk with your advisor about what it means for you longer term.
Excellent. And then cryptocurrencies as
Cryptocurrency. So gold has been a great addition to client allocations this year as a diversifier. Gold functions in a couple of different ways over different periods of time. Bitcoin, in some ways, as an example of a cryptocurrency being thought of like digital gold. And in some periods of time, it functions as a diversifier. In other periods of time, it's shown relatively high correlation to other things like technology stocks. We are long-term optimistic around some of the major cryptocurrencies, not all of them, but things like Bitcoin and a couple of others where there is significant value outside of just their diversification potential, but they have functional utility in different payment systems and applications. So we are optimistic about that, but again, it's still early innings. It's relatively volatile, pretty high risk. So for most clients, we recommend a relatively small allocation.
and some of that for the benefit of how volatile it is that you can own a little bit and get a big impact in the portfolio.
Exactly.
Yeah. Excellent. Well, I'll give you a break here. I've got a planning question that I can jump into here. And again, if there are other questions, feel free to enter those in the chat here, because we're coming up on the end of what we have written down already. So one of the questions that had come in prior to the call was around protecting someone's estate from an inheritance tax, specific to the state of Pennsylvania. So I think there's some broad application of this across, others. So sort of generalize it a little bit, but, the first and foremost, which is, not meant to be totally provocative, but you can move. So you can leave Pennsylvania before you die, and you got to do that before a year before you die. So not many people have got the foresight to be able to do that, but that's one way to avoid the inheritance tax. And there are far more states that do not have one than do. So that's the first one. But if you say, hey, this is home and this is where I want to be, how do I, again, avoid that inheritance tax? A lot of it is going to be around, lifetime gifting. And so there's the outright gift, so a conclusion of a gift that would be made to anyone. So it could be, an heir, it could be a friend, grandchild, anything like that. Um, the lifetime exclusion amount that you get the benefit of, which is indexed for inflation. So this year it's $14 million for the individual, $28 million for a couple. So from a federal standpoint, you've got that as a exclusion amount. When you're looking at it from the state standpoint, so giving all of that stuff out of your estate in advance of passing away would avoid that inheritance tax because that's ultimately going to be assessed at the time that you pass and what's in your name still. In addition to that, if you were to use up all that exclusion amount, there's the annual exclusion. So you can give gifts up to $18,000, again, indexed for inflation. So it grows each year by a little bit. And that's per individual. So there's some, easy ways to do that. As you get more complex beyond that, it turns into discussions around irrevocable trusts, where you're actually, making that gift outside of your estate while you're living, still using those lifetime exemption amounts, but ultimately not having control over that, but still being able to protect those assets, in the form of a trust. And then a few other things. There's life insurance proceeds would not be taxed through inheritance, and then out-of-state real estate. So if there was a second home that was outside the state of Pennsylvania, if it was titled properly, in an LLC for the benefit of others, that would be another way that you could avoid that inheritance tax. So, and then all that to say, beyond just heirs, there's charitable planning that can be done as well. So lots of different ways. Certainly encourage anyone that may apply to reach out to their advisor and have a more specific conversation. But a very, very good question. And then the last one that I see here for the moment is in thinking through going back to the investment side, Chris, and this is my interpretation of the question, but if you had just a couple of years investment time horizon, so 2 to 3 years, and you had to develop an investment strategy around that, not knowing again what the outcome or goals, but ultimately it's probably not to lose principal, earn a reasonable rate of return. How would you construct that portfolio, assuming that it's going to be in fixed income, between taking duration risk, credit risk? What would you recommend?
Well, I'm glad you said just in fixed income. So, but yeah, if we're thinking about bond portfolios for the next couple of years, 2 to 3, 4 year time horizon, even with that in mind, where interest rates are at today, where the level of interest rate differences between maturities, shorter term versus longer term, we're still in sort of an oddly shaped yield curve, but relatively getting back to something a little bit more normal based on Federal Reserve's interest rate cuts over the past couple. So the opportunities are kind of in the middle. It's sort of the intermediate maturity range where there's some good benefit to picking up incremental return relative to extending duration. But that said, most of it could be just in the treasury market or government guaranteed bonds. Corporate spreads or yields relative to treasuries are really tight at historic near all-time lows, meaning we're not getting compensated or paid to take that additional risk in some in corporate bonds. Investment grade bonds, many of them are quite safe, and we're comfortable with holding some of those bonds. But for a shorter portfolio over a 2 or 3 year time period, it would probably be a mix of shorter term government bonds and shorter term, really high quality investment grade corporate bonds. The longer you go out in terms of duration, obviously, the more interest rate risk. And given the federal government's current situation, we really don't like the longer maturity government bonds. So we'd really stay relatively short for a shorter time horizon type of portfolio.
Excellent. Very good. Well, those were all the questions that we had. Any additional parting thoughts here in thinking forward to, rounding out this year and heading into next?
Well, just thanks again to everyone for joining us today. This is a really interesting time. There are so many different conversations that you probably should be having with your advisor about your plans and your goals, depending on your time horizon, as Jeff alluded to at the last question in particular. But given the concentration in the market, the valuations we're at today, definitely have a conversation about your longer term goals. Make sure you feel comfortable with your allocations and that you're prepared for some possible type of correction or some pullback in the market whenever it might come in the future.
Well said. Well, thank you everyone for joining us. This was terrific. Thank you, Chris, for sharing all of your valuable insights. And again, everyone's advisor is open and available to further the discussion on anything that was left unanswered or questions or a specific situation that you have. So again, thank you everyone, and we very much look forward to getting together again soon. Thanks.
Thank you.